When it comes to retirement, time is your biggest asset. I'm going to show you guys step by step how you can start at a retirement account and what to invest in that retirement account. Because like I said, time is your biggest asset, especially when it comes to compound interest. For example, if you are 20 years old and you're going to retire about 65, and you just start putting away $50 a week, that's $200 a month. So by the time you hit 65, you'd have over $1.7 million. Now, if you waited 10 years, just 10 years, and you started when you were 30 with that same $50 a week, which is $200 a month, you're looking at $656,000. That's literally $1 million less just by waiting 10 years. And now I can already see in the comments section,
well, I'm not 20 years old, I'm not 30 years old, I'm 40.
Okay, the concept still applies. Time is what matters, so get invested today after watching this video and learning everything about retirement. So first, let's talk about the 401k or the 403b, which are basically the same thing. It just has to do with whatever type of job that you're at. If you're at a regular for-profit institution, it's probably a 401k, and if you're at a non-profit institution or a private school or something like that, it's probably a 403b. So now if your work gives you a 401k or a 403b match in any way, take that match. That's just basically free money that they're giving you on top of your salary. They're basically just saying, hey, if you put in $200 into your retirement account, I'll put in $200 into your retirement account as well. It's a pretty good deal. So if you don't know already, ask if there is a 401k match or 403b match and max that out. Now, I wouldn't recommend maxing out higher than what the match is, just because for the most part, 401ks or 403bs have a little bit higher of an expense ratio. And I'll show you about expense ratios later on when I talk about exactly what to invest in your 401k or other retirement accounts. The next type of retirement account would be called an IRA or an individual retirement account. It's basically the same thing as the 401k or 403b in that it's a retirement account, which means you can't touch it till about 59 and a half years old. And it's a way to somewhat force you to just put money away so that you're safe later on in life. The individual retirement account is for people who don't get a 401k usually, and so it's a way for you to do it even if your job doesn't offer one. I would recommend that you have both a 401k and also an individual retirement account. And again, it has to do with the expense ratios that I'm going to show you later on. As far as the individual retirement account, you have two options. You could either go with an IRA, a regular IRA, or a Roth IRA. Now, there's just one basic huge difference between an IRA and a Roth IRA, and that's just about when you get taxed. So a regular IRA, you're basically putting money in, you're not being taxed on that money up front, but later on, when you turn 59 and a half or whenever you want to start pulling some of that money out for retirement, they will tax it right then and there. So say at that point you have $10,000 that you want to pull out at retirement age, they'll tax you about 20% or whatever it is. And so when you pull $10,000 out of your IRA, you're actually only going to be able to use $8,000 because $2,000 or 20% will go back to the IRS. Now, conversely, with the Roth IRA, you are taxed up front. So you're taxed right now before you put the money in, and then while the money is sitting in the account and as it grows, all of that is tax-free. So later on in retirement age, same thing, you want to pull $10,000 out, you pull $10,000 out of your Roth IRA at that point, and you are taxed $0. So all $10,000 is yours to keep. Now, the reason why I like the Roth IRA over the IRA for right now, especially at a younger age, is because I can just see tax rates going up and up and up, especially with that certain virus that went through, and then the stimulus money, and then all that money that the Fed just threw into our economy. And lately we've been seeing inflation just go crazy. The only way we're ever going to pay all that money back is going to be through taxation. And so tax rates are going to go up. And if tax rates go up in 30 years, and that's when I'm going to be taxed, I'd rather have something where I'm sheltered from that tax at that point. But for me, I'd rather get taxed right now on like the smaller amount, put that money in, let it grow and compound, make it an even bigger amount, and then at that point, I don't get any taxes. So now the most important thing that you need to understand in this video is that when you put money into the 401k or into the IRA or Roth IRA or whatever, that's just like a bank account. It's just like an account. So you put the money in, but it's not doing anything other than just sitting there unless you make it do something. So the best way to make use of that is to invest that money. Now, most of your guys' 401k or 403b accounts are set to something automatic. And so you want to check into what exactly that is, but it's probably something super safe so that your money can grow at a small percentage rate every year. But it's something that you can change, especially if you start to learn a little bit more about what funds might be better for you and especially for your goals. But as far as the individual retirement accounts, like the IRA, Roth IRA, if you literally just put money into that account, it'll literally just be like a savings account and it'll just sit there. So you do need to set what that money goes to once it's in the account. And so I'm going to show you that right now because that's the hardest part, most complex. And now, first and foremost, when you're investing for your retirement, it needs to be a different mindset than if you're investing for something that you're going to pull out within a year. If you're going to invest in something for a year or 2 or 3 or something like that, you want something that's high return very, very quickly, maybe an individual company like Apple or Microsoft or Amazon. But when it's retirement, you basically want to make sure that it grows steadily and grows as big as possible, but that there's no real huge risk. At the end of the day, they call it the nest egg because this is the thing that you're literally going to live on. So really, the two places that I tell people to invest, either in index funds that are safe with low fees or in a target date fund. And so I'm going to show you both of those because for 99% of people, that's where their retirement savings really should be. And real quick, a target date fund is just basically a fund that's kind of set up for you so that you don't have to do anything ever. It's targeted to when you might retire. So for me, if I'm going to retire at like 65, it would be around 2055. And so what happens is, since I'm far enough away from retirement right now, it's a little bit more risky, a little bit higher in stocks and a little bit of bonds just to make it somewhat safe. But as I get closer to that retirement age, like in 2045 or 2050, things start changing. And so then they bring down the amount of stocks and bring up the amount of bonds. So that's the advantage of a target date fund. It's really, really super passive where you could literally just put money in every single month forever and know that you're probably going to be okay with that. So let's start with the target date fund so I can show you exactly what to do. I really like Vanguard. I think that Vanguard is one of the safest and also has some of the lowest fees out there. Knowing that you're saving and investing for retirement, so you're going to be doing this for multiple years. And so any fee that's a little bit higher than anything else really compounds long term. So first is the 2055 fund, and this is what it looks like. This is the ticker symbol here, VFFVX. So for me, this is the one that I would probably invest in if I wanted to do a target retirement fund. As you can see here, we have about 0.15%, which is super low as far as expense ratio. You can see down here, over the last year, it was about 16%, 16.5%. For the last 3 years, it's gone up about 19% per year, so great. You can also see down here what's actually in this portfolio. So we have stock market, total stock market index about 54%, international stocks 36%, and then less than 10% of bonds. Now, if we look at the difference between the 2055 and 2035 fund, if I was going to be retiring in about 10 years or so, still low fee. The total return last year was about 13%, which is lower than the other one, of course. And as you can see here, now the stock market index is about 45%. International is about 30%, and bonds is more like 25% rather than less than 10% that it was in the 2055. Even more so if we're going to look at 2025. So if I was going to be retiring in the next 3 or so years, last year it did about 10%, which is still great. On average, about 15% for a very safe fund. That's really, really good appreciation. As you can see, the stock market index, 35%. Now bonds is super high, right? 30% of that bond We have international bonds of almost 15%. So as you can see, the bonds have really rised, and that's because bonds are considered to be some of the most safest investments. And so if you're going to be retiring very soon, you want something safe that you can make sure that your money's going to be there. So now, like I said before, there are two different things that I recommend people might want to invest in as far as retirement. One is that target date fund. The other one is just solid index funds with very low fees. And to me, there's only two that I really like for long-term investing, and that is the S&P 500 or the total stock market index. S&P 500 ETF that they have is VOO, VOO, and as you can see, the expense ratio is 0.03%. The target date funds were 0.15%, so this is literally 5 times cheaper. Now, as you can see, the return has been absolutely insane. The last year was about 29%, which is crazy and not normal. The last 3 years, about 26%, but 5 years, 10 years, still over 15% per year. That is solid appreciation. Down here, you can see what it's invested in. You can also see the 10 largest holdings, Apple, Microsoft, Google, companies that you definitely want to be a part of. The other one is VTI, and that's the total stock market ETF. Again, 0.03 expense ratio. As we can see here, still crazy solid appreciation, 25% last year, 25% or more over the last 3 years. For the last 5 to 10 years, over 15% as well. Very similar to S&P 500, which is why I really like this one. You can see what the portfolio is comprised of, and then also their 10 largest holdings, which again are very similar to the S&P 500. So the reasons to pick index funds over the target date funds are only if you really understand the index fund and you really think that that's going to be better suited for your personality. For me personally, I pick those index funds versus the target date fund because I understand how the market works. And for me, I want to have a little bit more control. I don't really want to be invested in bonds at this moment because you just get such a more high return on stocks and on the index fund. And so I'd rather take advantage of those as I'm a little bit younger. And maybe as I get closer to retirement age, I'll switch that money out to something safer at that point. For most people though, I would say 90% of people, the target date fund is a perfect place for you to put your money. Very safe, but still, as you saw, crazy high appreciation, way higher than inflation, way higher than you'd get in a savings account. So now I'm going to teach you step by step how to create this IRA or Roth IRA. Now, I've already done a video on how to do this through Charles Schwab and specifically how to open up a brokerage account. And so if you'd rather go with Charles Schwab, check out that video. And this one I'm going to go through Vanguard just because they're another company that I absolutely love. So you're going to type in Vanguard.com. You're going to go ahead and go to Personal Investor because it's an individual retirement account, IRA. Go over here, super easy to open an account. Then you're going to start a new account. We are going to use the electronic bank transfer, just basically saying that you are going to use the money that's in your account, or you're going to transfer over, say $500, $1,000, something like that to get it started. So we'll go there. You can see how to do that here, but let's just move it through. I'm new, I don't have a login. And so then it's going to take you to this page. You're going to choose an account type. So you're going to figure out, is this retirement, general investing, education? For you, you're going to pick retirement. Then you're going to complete an online application. And then from there, you're going to start investing. And so number one is where you're going to pick IRA or Roth IRA. So whichever one from earlier in this video that sticks out best to you. And you can always change it if you want to. You can always move funds from one to another. And then number three there is the last part that I was just talking about, where you can pick either a target date fund or S&P 500 or total stock market index or whatever suits your investing needs. You can also have 50% of your funds going to a target date fund in 2055, and then also 50% going to the S&P 500. It doesn't all have to go in the same place.